Hey y'all, how's it going? I'm trading the ES futures on a 2000 tick chart with a 21 EMA. So I've got the overnight highs up here, overnight lows down here. These are our key levels for the day. So I started trading this area right here. This is 8 o'clock Central Time, so we're pushing down. I don't like any of these corrections on the way down because they don't reach the EMA, and you need them to reach the EMA. And so, just shallow corrections. We're dropping like a rock. Notice how, I talk about symmetry. If you watch my videos, I talk about symmetry trades. Now, notice how we spike up here and then we spike back down. That's very common. When you spike up in one direction, you can expect a spike back in the other direction. You can use that to enter if you get a good setup. I don't see any good reason to go short up here. But you can also get smaller trades with the momentum down, which actually has to do with this trade right here, but I'll get into that when we get to it. So we have this drop right here. We have a break from the downtrend. We have these two legs pushing up to the EMA, which is where you'd want to look for a short. However, you're right into this resistance right here. You might expect to see prices possibly test down here, except you clearly got resistance forming right at this level here. So you don't want to enter short right into that. Ideally, what would happen is you'd break out of this, reach that measured move, and get a bear bar closing at the high with enough room to actually reach those lows without having to go through them, especially not closing all the way down at them. So we push lower here. Unfortunately, no way to get into that safely. We push lower here. We have downtrend, break, first attempt at a new low, and we can expect a possible second attempt at a new low because that's how prices move. That's how second entries form. Market moves in twos. Notice how after we get these two legs down to a new low, perfectly measured, that's when we reverse here. So that's not a coincidence. That's how the market moves. It moves in twos. And so, like I was talking about the symmetry, the momentum from the symmetry, we still haven't quite reached the overnight low, which is when that spike started here, and you can expect a retest of the overnight low, which has to do with this right here. Even though you have that first entry, second entry, it's not a clear second entry, on a bigger picture. I usually like to see clear legs, like these are more significant than this second leg right here. But the EMA was holding well, and it was extremely bearish. I mean, it held well here. It just, as soon as it tapped it, it just shot down, and then here we're getting a lower high off of it. So the EMA is holding well. It's dropping like a rock. You're still expecting to retest the overnight low using that symmetry momentum. And then we push lower. I wanted to get out before the overnight low, of course. You don't want to expect it to push through. Now, one thing I want to mention is, say we reached the overnight low here on that first attempt. So downtrend, break, first attempt, and say we actually reached the overnight low and then got the same setup here. There's no way I would take it then, because if you bounce off the overnight low, that's just a very significant level. It can tap it and just go straight to the other side of the, go straight to the overnight high. So there's no reason to, there would be no reason to enter short if we had reached it there, because it would just be way too risky. But since we're expecting prices to at least retest it, because that's how prices do, these act as magnets, just like any range. Overnight levels also act as magnets, just like channel trend lines. They act as magnets. So do overnight highs and lows. These are very significant magnets because they're the key levels for the day. The overnight highs and lows are the key levels for the day. They're the most important things. They're probably the most important level of the day. So we push lower here. We get that perfect measured move. As soon as we reach that measured move, we just reverse back higher. Now, there's no clear entries on this way up, unfortunately. You just push through the EMA. You get these corrections that don't even reach the EMA, so you don't want to enter on those. And then, so you have this first leg up, break. You can expect a second leg up. Now, ideally, what you get here is the push up, break, and then you enter on the second attempt higher. So like uptrend, break, first attempt higher, second attempt higher. But instead, you get this, which you don't want to enter right into that high right there on an entry like this, which I don't want to get ahead of myself here. Let me talk about this first. So you push below the EMA. Obviously, you can't enter on that. It's not off of any kind of support at this point, and it's also just very bearish. Shot below, closed below the EMA. And then you pushed even lower right here, and it also got choppy at this point. But then you do push higher here, and then you hold above the EMA. You bounce off the EMA, you push higher here, except it's not a very significant, it's not like a significant second attempt entry. It's still kind of going along with that first attempt higher here. So I would want to see a more significant separation between that first attempt and the second attempt, because there's a couple things. So if you draw this right here, like say you have that push up here, break, and you draw the measured move for it, it's not very far, and you would be going right into that high at the same time. So I would just want to see a more clear separation there. Um, it's not like there's a magnet close that you're expecting to retest at this point, like right here. So there's really no reason to enter that, unfortunately. But it does go higher here. It kind of goes choppy for a bit, but then it pushes higher there. And then let me redraw this. At first I had this range like this, of course, and then that's where I got stopped out here because I made the mistake. I was kind of, we had this first entry here. It was really just a first entry. I kind of tricked myself. I was telling myself, it's kind of like a triple test because you got that right there, then you got that second, and then third, except it's, it pushed through and then it got choppy. So it was getting choppy. It wasn't a perfect triple test anyway. It was pushing through it, and then, it was really just a first entry. And so that's my biggest mistake here, was right as we made a new high. So uptrend, break, new high, and then a one leg down. That's a big mistake because when prices make a new high, you can expect, two-legged correction. Like I say, prices move in twos. So when we only got this one good leg down right after making a new high, that's a pretty bad mistake. We bounced right off that high right there. So, that was not good. But as soon as I got stopped out, it just immediately led into this much better looking trade because you have two clear legs down. You got this uptrend in play here. It's holding on that trend line. Third bounce off the trend line. The highs are fitting well. And, I still wanted to get out before that high right there because it did reconfirm that high right there once it bounced off there. So I wanted to get out before. So this is 1.8R. And yeah, just a bad mistake. As soon as you make a new high for an uptrend, you don't want to enter long after one push down. That's just not good enough. I mean, I'm sure this is a good scalp entry. I don't want to advise on scalping because I'm not a scalper and I'm not good at it. I'm not good at scalping. I go for the bigger trades, which I know that some may view one-to-one as scalping because I do a lot of one-to-one. But I'm talking about like the 1-point scalps, the 2-point scalps. Maybe it's good to ride to that high right there, but once again, I'm not a scalper. I'm not going to really get into that. So that's why I like this right here. Two clear legs down. That's two attempts to reverse. It was held up by this trend line, getting out before the range highs right here. That's a good looking entry. So we push higher here. We don't really go further. We bounce pretty much right off that. I mean, we pierce through it, but the bodies hold on it. And then we kind of start getting a little bit choppy here. We're chopping, between the trend line and the range right here. We push up here. When you push down really hard like that, right up, once again, you just made a new high right there, and then you got one leg down. You don't want to enter on that. You want to wait on a second leg. But at this point, it was kind of just, getting a little bit choppy. It wasn't holding on the trend line as well anymore. And then I just don't see a real reason to enter that. I mean, I see the two legs down, but it's just right after a big drop, and then there's not really any separation like there is with this one. So I don't like that. We go sideways a bit. We continue going sideways. It's just choppy, no clear entries in here. We push higher here. We just reached that measured move. Notice how as soon as we reach that measured move, we start reversing. So these are very important measured moves. Measured moves, it's not a coincidence that it's bouncing right there. Just like it's not a coincidence when it's bouncing at that perfect measured move. Or, we have two legs down there, then it reverses, and you can go through every day, just study the measured moves. Study the moves of twos. It's very important. There's a reason this market geometry exists, because people trade based off of it. The big institutions trade based off of it. So that's the thing. It's like, it's advanced. Price action is advanced to learn, but it's kind of simpler than people think. That's why people get caught up with a million indicators, because they think it's going to make stuff easier. But the big institutions that trade, I mean, they know the key levels, they know the basic market geometry, and then, they do have a lot of volume, so they can move markets, but it's really just the main thing is the key levels, overnight highs, overnight lows, measured moves, and trend lines. That's what's important. You don't got to worry about all the indicators. Even like a volume indicator. I don't use a volume indicator. I know some people like to use volume indicators. I do not, because one way that you can tell volume is just how fast the bars are moving on a tick chart. How fast the bars are moving on a tick chart, or even a volume chart. That's a good way to see, just depending on how fast the bars move and how fast they form. So And also, people use RSI, which, I mean, I don't know a whole lot about the indicators because I don't use them, so I'm not trying to knock anything here, but people will use RSI and other indicators to see oversold and overbought levels. One way you can tell if something's oversold or overbought is with overshoots of trends. I mean, that's how I tell them. So, anyway, just thought I'd talk about that for a bit. In my opinion, it does get a lot easier when you just ditch all the indicators. There's really no reason to use them, in my opinion. I'm not trying to knock anybody's way of trading, but anyway, thanks for watching. Hope this video helped in some way, and I'll see y'all next time.